Boom and crash strategy. Do you know why sometimes you place your trade and then it spikes and hit your stop loss, and later on you see the trade move in your favor after it has taken you out of the market? One of the reasons why that usually happen is because of the institution and the banks. So sometimes they usually manipulate price and cause price to hit retail trader stop loss before they can actually have much liquidity to take trades. And when that happens, you usually create what we call order block and institutional candles. So this is a very simple boom and crash strategy that I'm about to share with you. You can use it in trading via X75, you can use it in Nasdaq, but I'm going to share with you in boom and crash. All right, so you are going to see a very simple and straightforward strategy that actually works very well, and I've tested above 100 trades using this strategy. So let's head right down into it. Now I'm going to explain to you guys, and then I'll show you just like a couple of examples, and then you understand the concept. So this is how it usually happens. Now we usually have what we call the market makers and the institution, and sometimes they have influence on the market. Okay, let's say we have what is support zone here. Okay, now you see price actually consolidating. Let's just say price after moving, or let's say after breaking through this zone, it came back now and tested once, okay, went and then came back again and then retested the zone twice. All right, so normally we will always have people now who will be looking to buy in case price comes back the third time. All right, so we always have people who will be looking to buy. Now what happened? Price now might move up, okay, and then maybe coming back the third time. Now we have many buy orders around there, we have buy limit orders around this zone and all of that. Now what the institutions and the banks usually do is this: they will actually drive price down. All right, they will drive price down here, okay, when many people have already bought, so probably their stop losses are below here. Now what happened? They will actually hit all of these stop losses here. All right, now they will actually drive price now up. Price is going to move back up this zone, and when they move back, you see price will move up very powerfully. What happened here is what institution manipulation, and when they happen, this candlestick that caused this breakout is known as the order block or institutional candle. And then now what happened? Now they will now have negative orders running. So after they do this, they will actually do this by having negative orders. Okay, so price will always come back now to mitigate this order. These negative orders are sell orders, heavy sell orders that they place in order to move price down, because if they don't do this, price will not move down, so they will sell, and when price start moving, they're still in the negative order. Okay, I've made videos in which I've explained this detailedly, but just understand the simple concept here. What happened was they manipulate now and close a lot of traders here. They will now have negative orders running. They will always have now to move price down to come to where they actually placed the sell heavy orders to mitigate their price, and then it caused price now to move up. Okay, so what happened here is what institutional liquidity grab, and what happened here is mitigation. And when that happens, you can take advantage of this and enter when the banks are equally trading. So if you are able to identify this opportunity, you can trade with the banks. Let me show you the simple thing in the market. All right, so we have a scenario here which explains that fact. Okay, we have an uptrending market. Now we see price created what this demand zone here, which is like a support. Price rejected once, twice. Okay, we had a lot of people now who are now buying here. We have people who are placing buy limit orders. As price start coming down, they are placing buy limit orders, and when the price goes to this point now, what happened? It actually triggers with this strong bullish candle. Now other people who have fear of missing out will be jumping in. Some people will even be entering right up here, and then they'll be placing their stop losses below here and targeting somewhere high. But what happened? Price will move down. The institution now will place sell orders and move price down. What happened? Price comes down here and then hit the stop losses that are below this zone. Once price move up now, it will come back to mitigate the zone. So you can equally take advantage. Now you see that this is what we call the order block. This zone here, you see the order block below here, the order block or institutional candle. Now you see that this candle have been formed as a result of institutional manipulation. Okay, so now when that happens, you see the next candle is very bullish. You see that it closed above the zone, and in most cases you might take your trade sometimes here. You see that price will move right up. Okay, sometimes it just go and breaks, but if it comes back to mitigate, this is what I call mitigation. When it comes back now, it's coming back to mitigate this zone and then to close those negative orders that were left. So you just understand the concept. Though I've made a detailed videos, and I've explained exactly how these banks usually do. Okay, you can check it in the video's description and then you understand that. But if you just watch this video and you just understand the concept, that after these rejections we only have what? Liquidity grab, and after the liquidity grab sometimes price will come back to mitigate. So just from this concept you can get actually catch some good setups. All right, so look at it here. We have similar scenarios here. Okay, so we have a zone created. Now we saw price move and then it came back. Now we saw what? Rejection around this zone here. So we have a zone here that price have been rejecting. Okay, once, twice, thrice. Okay, normally we have a lot of sell pending orders here, given that the market was going down. Okay, what happened? Price now closed above the zone, so it break and then close above this zone here, creating this institutional candle or order block. Okay, so many stop losses. Just imagine that. Okay, I've been hit here and you see that price comes down back. When price moves down now powerfully, it comes back to mitigate the zone. So you see that when it came back, this one was now meant to mitigate the negative orders that were here, and finally we saw a down move. So normally I would have been using trading the replay tool of trading view to explain this, but unfortunately my trading view is actually my replay tool right now, it's actually disturbing. Okay, so we can see similar scenario here. All right, let's go to the 2 hours time frame so that you can easily see this very long spiking candlesticks. Okay, okay, so we saw this down move here. After price came here, price actually came down, and then after creating this high, price moved down, created a low here, came back. This is a rejection zone here. Okay, price got rejected here and moved down. When it moved down, now what happened? It was more like a kind of rejection. So now we have this as a high. Okay, now price coming back here. Now many people will consider this zone to now act as resistance, so probably they should be doing what? They should be selling here. Okay, so when they're selling here, what will happen now? They are placing their sell limit orders. Other people will be placing sell limit orders as price is moving up to this zone. And what happened? You saw a good rejection candle. Damn, this is a beautiful entry. Everyone is looking at it. This is a strong candle showing bearish pressure. So people, they will execute their trades normally. All right, their stop losses are above this zone here, and then you see price move down. Okay, you see that price in most cases price will act as if okay, it's moving, it's actually moving. What you did was gold, coal, and all of that, you see, and then you see that they place their stop losses above like that. Okay, they're targeting this zone. Damn, I've gotten my Christmas trade right here, so they will be so happy. Everyone walking out happy that, oh damn, I've gotten a good trade, giving signal, all of that. What happened? Later on we saw a very long bullish candle that closed above that zone. So this long candle now closed all of the orders here, and what happened? We saw another candle now which was like a bearish engulfment. So it was a bearish engulfment. We saw what? The institutional candle or order block here, and what happened? Price moved down after when this person have been stopped out, man. Christmas profits taken away, and what happened now? Price has to come back now to mitigate the zone. All right, so like I said, you can go back and watch the other videos. I've explained detailedly what mitigation is all about, how banks usually do all of these things, and so that you can not just trade. You should not just trade, you should understand the concept detailedly so that you can also teach someone. All right, so you see that price came back now to mitigate. Now this is another good entry from here. Now you can enter if you already had this knowledge. Okay, you can now enter, take your sell order here at this rejection. I see how price move with a lot of momentum. I see that whenever it happens, price will usually move with a lot of momentum. Okay, so you can go on and I'll show you more and more and more and more examples, because it's a concept that I understand how it functions. It's a concept where the banks actually play a role in driving price to move. Okay, so that's it, guys. That is it. Now what you do after watching a strategy like this is what you do, what we call backtesting. You can scroll back your charts, you try to identify similar scenarios, you backtest, you try to see how the trades that worked out, the ones that didn't work out, because it will not always work out 100%, right? It will never work out 100%. So don't be deceived on YouTube so that you go and then you risk all of your account in one trade because you are so sure. You will work many times, but it will not always work. So you do your backtesting and then you do your forward testing. Like I would say, make sure that you test 100 trades. Okay, it's a simple strategy that you can adapt as your personal strategy, and you make good money from it. But first of all, you need some work. You need to put in some work. You do back testing, you do forward testing, you take trades and you record. You take trades, you record. At the end of 100 trades, you see that how many trades did you take that you won, how many trades did you take and then that you lose, and then from there now you know the risk to reward ratio that you can be using. Okay, that is how you should be doing when you watch a YouTube video, when you watch a strategy. Okay, that's the mentality of profitable trader. It's not about just rushing into taking live trades without even practice or understanding the concept very well. So thank you for watching, guys. If you are new to the video, to the channel, just subscribe by hitting on the subscribe button and notification bell, so that whenever I post a new video, you are going to get notified. Thank you for watching us.